investment. Let's be honest, investing in the stock market seems simple on the surface. You hear stories of people turning a few $1,000s into a small fortune, and naturally you think it must be easy. The reality, everything makes a good investment, however, is completely different. Most Americans fail in the stock market not because it's inherently difficult, but because they approach it the wrong way, driven by emotions, misinformation, and a lack of strategy. Here's the good news. If you understand why most fail, you can use the exact same market to create lasting wealth. One of the biggest mistakes people make is letting emotions control their decisions. The market moves in cycles and prices fluctuate constantly. During a bull market, everyone seems to be making money, and the temptation to jump in is overwhelming. People buy into hype, fearing they'll miss out, often at the peak of a trend. On the other side, when the market dips, panic sets in. Fear dominates and they sell at a loss, locking in negative returns. Emotional investing is like driving a car while looking in the rearview mirror. You never see what's ahead. Winning in the market requires a calm, rational approach. You need to train yourself to detach from the daily noise, focus on long-term value, and make decisions based on logic rather than emotion. Another critical reason most Americans fail is the lack of financial education. Most investors don't understand the principles of risk, diversification, or compounding. They don't know how to evaluate a stock beyond the headlines, and they overlook the importance of asset allocation. Imagine trying to build a house without learning the basics of construction. You might get lucky, but more often it collapses. Investing is no different. By educating yourself, learning how to read financial statements, understanding market cycles, and knowing how to manage risk, you dramatically increase your odds of success. Knowledge isn't just power in investing, it's money. Chasing short-term gains is another common pitfall. The media glorifies stories of instant wealth, leading people to focus on the next hot stock or crypto coin. They try to time the market, hoping for a quick win. But the truth is, the stock market isn't a casino. Real wealth comes from consistent, patient investing. Think about someone who invests steadily over decades, reinvesting dividends and staying disciplined during downturns. They may start small, but compounding eventually turns modest investments into life-changing wealth. Short-term thinking produces stress, mistakes, and often financial loss. Long-term thinking, paired with consistency, invests and builds true financial freedom. Finally, a lack of a systematic strategy keeps most Americans from winning. They trade impulsively, follow rumors on social media, or mimic what others are doing. This randomness makes success dependent on luck rather than skill. On the other hand, those who develop a clear system, whether it's value investing, dividend growth, or index fund investing, know exactly how to act in every situation. A strategy provides structure, reduces emotional decisions, and ensures that you are working with probabilities in your favor rather than against them. So how can you win where most fail? First, control your emotions. Learn to observe market movements without panic or greed. Second, invest in your education. Understand the fundamentals and keep learning continuously. Third, focus on long-term growth rather than chasing quick wins. Lastly, create and stick to a systematic plan that suits your goals and risk tolerance. The stock market is not an obstacle, it's a tool. By understanding why most people fail and avoiding these common mistakes, you put yourself in a position to win. Success doesn't require luck, it requires discipline, knowledge, and patience. The path is clear: learn, plan, and act wisely. If you do that consistently, the stock market can become one of the most powerful wealth building tools available to you. Emotions are the silent killers of wealth in the stock market. One of the main reasons most Americans fail as investors is that they allow fear and greed to dictate their decisions instead of relying on logic and strategy. The stock market is a living, breathing system, constantly fluctuating with news, economic events, and investor sentiment. It reacts to real-world events, but it also reacts to perception. People who let emotions guide their investment choices are constantly at the mercy of these swings, often making decisions that are completely counterproductive. Fear and greed are powerful motivators, and they can make a rational person behave irrationally. When markets rise, greed often pushes investors to buy at the peak, driven by the fear of missing out, or FOMO. Conversely, when markets fall, fear dominates investment, causing panic selling and locking in losses. This cycle repeats endlessly for those who do not have emotional discipline, and over time, it eats away at potential returns. A clear example is during periods of market bubbles. When everyone around seems to be profiting, there is an overwhelming pressure to participate. Investors ignore fundamentals, valuations, and risk management, focusing instead on hype, excitement, and the potential of quick gains. They buy into trending stocks or sectors without proper analysis, convinced that the market will continue its upward trajectory indefinitely. This type of emotional investing is particularly dangerous because it distorts judgment. Rather than making decisions based on data, strategy and probability, actions are dictated by short-term sentiment. People are prone to overconfidence when markets are high, assuming they are smarter than the crowd, when in reality, they are simply riding momentum. The opposite scenario, market downturns, illustrates how fear sabotages investing. During corrections or crashes, headlines scream losses and anxiety spreads rapidly. Investors who react emotionally often sell their holdings at the lowest points, driven by panic rather than a long-term plan. This behavior ensures that losses are realized rather than temporary investment, and it disrupts the compounding growth that comes from staying invested. Emotional decisions also prevent people from taking advantage of opportunities. Buying when others are fearful is often the best strategy for long-term gains, yet fear blinds many from seeing potential. They exit the market entirely, missing rebounds and the eventual recovery that always follows. The impact of emotional investing goes beyond just buying and selling at the wrong time. It affects overall strategy and discipline. Investors might frequently switch between different strategies, trying to chase performance in hot sectors or mimic the latest guru they see online. Every deviation from a well-thought-out plan increases the probability of mistakes and reduces cumulative gains. Even small emotional decisions, repeated over months and years, compound into significant underperformance compared to disciplined investors who stick to a consistent approach. Emotional control is not an innate skill, yet it is cultivated. Successful investors know that the market's short-term volatility is irrelevant to long-term goals. They maintain a steady mindset, focusing on fundamentals and strategy rather than daily price movements. They prepare mentally for inevitable market downturns, understanding that losses are temporary and that periods of fear are often the best times to buy quality assets at discounted prices. They also understand that excessive greed can be as harmful as fear. Investment. Buying without regard for valuation or risk management is a quick way to experience losses when sentiment shifts. Discipline and routine are crucial in countering emotional investing. Many top-performing investors develop a systematic approach to buying, selling, and reviewing their portfolios. This removes the guesswork and emotion from day-to-day decisions. Instead of reacting to headlines, they rely on predetermined rules, research, and strategies that allow them to act logically. Another effective tool is education and preparation. Understanding market cycles, historical trends, and risk management techniques helps investors anticipate volatility and reduces emotional reactions. Ultimately, the difference between those who fail and those who succeed in the stock market is not intelligence or luck. It is emotional control. Fear and greed are not just psychological issues. Investment, they directly affect financial outcomes. Investors who learn to manage their emotions, stay disciplined, and focus on long-term value rather than short-term excitement are the ones who consistently achieve wealth. Emotional investing is a trap, but it is avoidable. By building awareness, discipline, and a structured approach, any investor can rise above the pitfalls that ensnare the majority. Controlling emotions is not optional. It is the foundation of success in the stock market. Financial education is the cornerstone of successful investing, yet it remains one of the biggest reasons most Americans fail in the stock market. Far too many people enter the market with little to no understanding of fundamental concepts, blindly trusting tips from friends, social media, or flashy headlines. Without a solid foundation, investors are essentially navigating a complex system blindfolded, and the consequences are predictable poor decisions, unnecessary losses, and missed opportunities. Investing is not a game of chance. It is a skill-based discipline. Understanding the principles behind it, risk, diversification, compounding, valuation, investment, and market psychology is essential to consistently generate wealth over time. One of the most critical gaps in financial knowledge is risk management. Many new investors underestimate the risks involved in individual stocks or over-leveraged positions. They assume that all growth is guaranteed or that past performance is an accurate predictor of future results. Without understanding how to evaluate and manage risk, investors expose themselves to catastrophic losses. Financial education teaches you to assess volatility, understand market cycles, and calculate the potential downside of any investment. It also emphasizes the importance of position sizing, asset allocation, and avoiding excessive concentration in a single stock or sector investment. By failing to grasp these concepts, most people inadvertently set themselves up for failure, often losing significant portions of their capital in a short time. Diversification is another area where financial education makes a dramatic difference. Many Americans focus on a handful of hot stocks, convinced they can pick the next big winner. This approach may work occasionally, but relying on luck rather than strategy is unsustainable. A well-diversified portfolio spreads risk across different asset classes, sectors, and geographies, reducing the impact of individual losses while capturing steady growth. Investors who understand diversification are far more resilient in volatile markets. They don't panic when one stock drops because they know their overall portfolio remains balanced and their long-term plan is intact. Ignorance in this area leads many to emotional reactions, investment, buying into hype, and selling in fear, which ties directly into the emotional pitfalls previously discussed. Compounding is another principle that is frequently misunderstood or ignored. Many investors focus on short-term gains, underestimating the power of reinvesting earnings over years or decades. Compounding is the mechanism by which small, consistent gains grow exponentially over time. Without education, investors often fail to leverage this powerful force. They may spend profits immediately, neglect long-term investments, or ignore dividend reinvestment plans. Educated investors, on the other hand, understand that patience and consistency are far more valuable than chasing speculative quick wins. They realize that time in the market, rather than timing the market, is the true engine of wealth creation, investment. Financial education also equips investors to analyze and value individual companies. Understanding balance sheets, income statements, cash flow, and valuation metrics allows you to separate solid investments from hype. Those who lack this knowledge rely on rumors, social media trends, or intuition, which often leads to overpaying for overhyped stocks. Learning how to read financial statements and interpret key metrics gives investors a measurable, data-driven approach to decision-making. This reduces reliance on luck and minimizes exposure to speculative bubbles. Education empowers investors to act logically rather than emotionally, creating a clear advantage in a market where the majority act impulsively. Another often overlooked aspect of financial literacy is understanding market psychology and cycles. Investors who recognize patterns of fear and greed, economic expansions and contractions, and investor behavior over time are better prepared to navigate volatility. Education helps develop perspective, understanding that downturns are temporary, that overreactions are common, and that long-term trends matter more than short-term swings. Those without this knowledge are easily swept up by panic or euphoria, selling low and buying high, the exact opposite of a winning strategy. Ultimately, financial education is what separates consistent winners from those who fail. Knowledge reduces uncertainty, minimizes emotional mistakes, and provides a framework for decision-making. The stock market does not reward ignorance or speculation disguised as insight. Success comes to those who take the time to understand the mechanics of investing, the principles of risk management, diversification, compounding, and valuation, and the psychology of markets. By committing to continuous learning and applying these principles consistently, investors can dramatically improve their odds of winning where most Americans fail. Education transforms investing from a gamble into a skill, giving you the confidence, tools, and strategy to navigate the market successfully and achieve long-term financial freedom. One of the most significant reasons many Americans fail in the stock market is their obsession with short-term gains rather than focusing on long-term wealth creation. The allure of quick profits, hot stocks, or get-rich-quick schemes is powerful, but it's also one of the fastest ways to erode capital. Short-term thinking encourages impulsive decisions, emotional trading, and a constant search for the next hype, all of which undermine consistent investment growth. The reality is that the stock market rewards patience, discipline, and a long-term approach far more than it rewards timing the market or chasing fleeting trends. Those who focus on building wealth over decades rather than weeks or months enjoy compounding, stability, investment, and a far greater probability of financial success. Many investors enter the market convinced they can beat it by picking winners or timing swings. Then, they read headlines about a stock doubling in a few weeks or see stories of rapid gains in certain sectors, and they feel compelled to jump in immediately. This mindset is dangerous because it is reactionary rather than strategic. The stock market operates in cycles, and what goes up quickly often comes down just as fast. Investment investors who chase short-term momentum frequently buy at inflated prices and sell during corrections, locking in losses instead of capturing long-term appreciation. This behavior is a direct contrast to the approach used by disciplined, long-term investors who understand that time is one of the most powerful tools in wealth creation. The power of compounding is inseparable from long-term thinking. Compounding occurs when earnings generate additional earnings, creating exponential growth over time. However, it requires consistency and patience. Investors who focus solely on short-term gains often interrupt compounding by selling early or moving in and out of positions. On the other hand, those with a long-term mindset reinvest dividends, maintain steady contributions, and allow their investments to grow uninterrupted. Over decades, even modest, disciplined investments can accumulate into substantial wealth, whereas short-term speculation rarely produces reliable results. The lesson here is clear: building real wealth is not about finding the next trending stock. It's about committing to a consistent, strategic approach that leverages the power of time. Another problem with short-term thinking is the stress and emotional turbulence it creates. Investment. Investors constantly watching daily price fluctuations are susceptible to fear and greed, which leads to poor decision making. One day the market rallies and they are euphoric. The next day it falls and panic sets in. This roller coaster of emotions drives impulsive buying and selling, increasing transaction costs, tax liabilities, and the risk of underperformance. Conversely, investors who adopt a long-term perspective focus on the bigger picture. They evaluate portfolio performance over years, not days, and they make decisions based on fundamentals rather than market noise. This mindset reduces stress, encourages rational decisions, and allows for consistent progress toward financial goals. Short-term obsession also drives a herd mentality. Many people chase what everyone else is buying, amplifying bubbles and crashes. They buy high because it's trending and sell low because of fear, repeating a pattern that ensures subpar returns. Long-term investors, however, think independently, ignore the hype, and stick to a strategy that aligns with their financial goals. They are not swayed by daily market chatter or sensational headlines because their focus is on building wealth steadily and sustainably. This independent thinking is a key differentiator between those who succeed and those who fail. To adopt a long-term mindset, it is essential to have a clear plan, realistic expectations, and disciplined execution. Long-term investors identify quality companies, understand their fundamentals, and hold them through market cycles. They diversify across assets and sectors to mitigate risk, focus on dividend growth and reinvestment, and commit to consistent contributions regardless of market conditions. By staying patient and disciplined, they allow their investments to grow with the economy, benefiting from both capital appreciation and compounding returns over time. Ultimately, the stock market is not a sprint, it's a marathon. Short-term thinking leads to impulsive moves, emotional stress, investment, and lost opportunities. Long-term wealth comes to those who are patient, disciplined, and committed to a strategic investment approach. By shifting focus from quick wins to sustainable growth, investors can avoid the mistakes that trap the majority of Americans and position themselves to achieve lasting financial freedom. Patience, consistency, and a long-term perspective are the true keys to winning in the stock market. ChatGPT said one of the most overlooked yet crucial reasons many Americans fail in the stock market is their failure to implement a systematic, repeatable strategy. Without a clear plan, investing becomes a series of random decisions based on rumors, trends, or the latest hot tip, and luck plays a far greater role than skill. When investors lack structure, investment, they are more susceptible to emotional decision, making impulsive trades, and poor timing. A systematic strategy, on the other hand, provides a framework for decision making, reduces stress, and allows consistent, disciplined actions that align with long-term goals. The difference between those who succeed and those who fail is rarely intelligence or luck. It is consistency and process. Many people approach investing as if it were a game of chance. They read a headline about a stock surging, invest impulsively, and hope for the best. When the stock drops, they panic and sell, only to chase the next trending stock. This random approach ensures inconsistent results because it lacks analysis, risk management, and repeatable methodology. Investing without a system is like sailing without a compass. You may move, but you have no idea where you are going or if you'll reach your destination. Without structure, short-term outcomes dictate behavior, emotions dominate decisions, and overall portfolio growth suffers. A systematic approach begins with clearly defined goals. investors need to determine why they are investing, whether it's for retirement, investment, wealth accumulation, or a major purchase in the future. Goals provide the foundation for all investment decisions, including asset allocation, risk tolerance, and time horizon. Those without specific objectives often drift aimlessly, reacting to external noise rather than making strategic choices. By setting clear targets, investors can measure progress, stay disciplined, and resist the temptation to deviate from their plan when markets fluctuate. Another key element of a systematic strategy is asset allocation. Understanding how to distribute investments across different asset classes, stocks, bonds, real estate, and cash, reduces risk and smooths out volatility. People who fail often concentrate their money in one stock, sector, or trend, exposing themselves to unnecessary losses. A systematic approach ensures diversification, maintains balance during market fluctuations, and reduces the impact of poor performing assets. Investors who follow a disciplined allocation plan are better prepared to ride out downturns and capitalize on long-term growth opportunities. Risk management is also central to a repeatable strategy. Systematic investors know exactly how much they are willing to risk on any single position and implement rules to limit losses. They don't chase returns recklessly. Instead, they evaluate probability, potential reward, and downside risk before making a move. This disciplined approach minimizes mistakes and ensures that no single trade or investment can derail long-term objectives. People who lack a systematic plan often ignore risk, trade impulsively, and suffer disproportionate losses when the market turns against them. A successful system also involves consistent monitoring and periodic adjustment. While long-term investing is about patience, it does not mean ignoring your portfolio entirely. Systematic investors review performance, rebalance when necessary, and make data-driven adjustments. However, these adjustments are part of a structured plan, not reactive decisions driven by headlines or fear. Regular review ensures the portfolio remains aligned with goals and risk tolerance while also taking advantage of emerging opportunities. Psychologically, having a systematic approach reduces stress and emotional interference. When investors know exactly when to buy, when to sell, and how to manage risk, they are less likely to panic during downturns or overreact to hype. Emotions are the enemy of consistent returns, and structure is the antidote. By creating rules and sticking to them, investors can act with confidence, knowing their decisions are based on strategy rather than impulse. Finally, a systematic approach encourages continuous learning and improvement. Successful investors develop processes that can be refined over time. They track performance, analyze mistakes, and iterate their strategies. Investment. This combination of discipline, consistency, and feedback creates compounding growth in knowledge and results, just as it does with capital. Those who fail, in contrast, often repeat the same mistakes, relying on luck or intuition rather than a proven method. In conclusion, ignoring a systematic strategy is one of the most common reasons Americans fail in the stock market. Random trades, emotional reactions, and lack of planning make long-term success highly unlikely. Conversely, developing a repeatable, disciplined system provides structure, reduces mistakes, and aligns actions with financial goals. With a clear plan, proper asset allocation, risk management, and periodic review, investors can navigate volatility with confidence, avoid the pitfalls that trap most Americans, and consistently build wealth. A systematic strategy is not optional. It is the foundation of lasting success in the stock market.